Hey there, everyone. Welcome back to our channel. If you're passionate about cryptocurrencies or just curious about how the digital economy works, you're in the right place. Today, we're diving into a fascinating topic, reserve assets in stablecoins. So, if you've ever wondered how stablecoins maintain their value and what keeps them stable, stick around. Now, you might be asking yourself, what exactly are reserve assets, and why are they so crucial for stablecoins? That's a great question. Let's break it down. To start, let's clarify what stablecoins are. Stablecoins are a type of cryptocurrency designed to have a stable value, typically pegged to a reserve asset like a fiat currency, think US dollars, euros, or even commodities like gold. This peg helps to mitigate the volatility commonly associated with cryptocurrencies like Bitcoin and Ethereum. Now, this is where reserve assets come into play. Reserve assets are the collateral or the backing that ensures a stablecoin maintains its value. Essentially, they serve as a security blanket. When you buy a stablecoin, you're essentially buying into a promise that it can be exchanged for a specified amount of the reserve asset. For example, let's take Tether, one of the most popular stablecoins out there. Tether claims that for every USDT issued, there is one US dollar held in reserve. This means that if you have one USDT, you can theoretically exchange it for $1, giving you confidence that your investment won't suddenly drop in value. But how do we know if these reserves are actually there? This is where transparency and audits come into play. Many stablecoin issuers undergo regular audits to verify that their reserves match the number of coins in circulation. This builds trust with users. However, not all stablecoins are created equal, and the level of transparency can vary. Let's look at another example, TrueUSD. TrueUSD is a regulated stablecoin that provides regular attestations from third-party firms to confirm that it holds enough US dollars in its reserves to back the tokens in circulation. This kind of transparency is crucial because it reassures users that their investments are safe and backed by tangible assets. Now, reserve assets don't always have to be cash-based. Some stablecoins are backed by a combination of fiat currency and other assets. For instance, DAI, a decentralized stablecoin, is backed by a mix of cryptocurrencies locked in smart contracts. This allows DAI to maintain its value without being tied to a single currency. However, it also introduces some risk since the value of cryptocurrencies can fluctuate. Let's talk numbers for a moment. According to recent data, the total market capitalization of stablecoins was over $150 billion as of early 2023, with Tether leading the pack, followed closely by USD Coin and Binance USD. This significant market presence highlights the importance of robust reserve assets in maintaining the integrity and trustworthiness of these digital currencies. But what happens if a stablecoin issuer fails to maintain their reserves? Well, that can lead to a loss of confidence among users, causing a run on a stablecoin, similar to a bank run. If everyone rushes to exchange their stablecoins for the underlying asset and the reserves aren't there, it can lead to a devaluation of the stablecoin. This is why regulatory scrutiny and transparency are critical in the world of stablecoins. Let's not forget about the regulatory environment surrounding stablecoins. Governments and financial institutions are increasingly paying attention to stablecoins and their reserve practices. In the US, for instance, regulators are discussing frameworks to ensure that stablecoins are fully backed and comply with existing financial regulations. This could mean more stringent requirements for reserve assets, aiming to protect consumers and maintain market stability. Now, you might be wondering about the future of reserve assets in stablecoins. As the crypto landscape evolves, we might see more innovative approaches to backing stablecoins. For example, some projects are exploring algorithmic stablecoins that use complex algorithms to adjust supply and demand without relying on traditional reserve assets. While this approach is intriguing, it also carries risks, as seen in the case of TerraUSD, which collapsed in 2022. So, to wrap it all up, reserve assets are the backbone of stablecoins, providing the stability and trust that users need in a volatile market. Whether backed by fiat currencies, commodity, or other cryptocurrencies, the health of these reserves is crucial for the credibility of stablecoins. As we move forward in this fast-paced digital economy, understanding how reserve assets function can empower you to make informed decisions about your investments. If you found this video helpful, please give it a thumbs up and share it with your friends. And don't forget to subscribe to our channel for more educational content on cryptocurrency and finance. Let us know in the comments if there are any other topics you'd like us to cover. Thanks for watching, and we'll see you in the next video.